would
Yeah.
be the magic wand or the solution to really solve all of the BS that goes on with taxes?
Magic formula is good money and low taxes. So if you have low, simple tax rates, so a system that's not characterized by high rates with lots of exemptions, but low rates with very few exemptions, lower the rate, eliminate the deductions, let the market set interest rate policies, and we'll have a bull market that'll make the 1990s proud.
Hey guys, welcome back to another episode of the Candy Valentino Show. I'm so glad that you are tuning in with us today, and we have a treat for you. I am so nerding out about having this conversation today as we get to talk to an economist, an author, an educator, somebody who holds a PhD from Harvard. So I don't know that I'm even educated enough to have this interview, but I am so grateful to have Brian, and I'm going to butcher the last name, Domitrovic. Did I say that? Is that right?
You got it right.
Brian, welcome.
Yep.
Thanks so much for coming on the show.
No, I'm really looking forward to talking. Thanks for having me, Candy.
Yes, thank you. And I know that I believe we got connected. You work with Art Laffer, who was on President Trump, President Reagan's Economic Council and board, and they spoke so highly of you. So I'm really grateful to have you here, because not only are you the co-author of Taxes Have Consequences, which we talk a lot about on the show, but you really understand this at such a deep level. And so I think there's so much insight that I would just love if you could share with us. Obviously, as I said, we have a lot of entrepreneurs, a lot of investors. There's a lot of things happening right now in the economy. There's a lot of nerves. There's a lot of people concerned. There's, all of these tax deductions have expired. We're coming into a new tax time. We're coming into an election cycle where, we've got so much craziness going on in the world today. Can you maybe share just what you see in all of your deep experience of what goes on as we're coming into an election year, and maybe what this means for entrepreneurs?
Sure. Yeah. I mean, typically election years have been very good for the stock market. I mean, it just historically, the stock market has loved it. I think the market reflects that in presidential election years, that politicians suddenly have to think about getting serious, and they maybe have to minister to the real needs of the electorate a little bit more. So, I mean, you can point to a lot of years. 2012 would probably be the most recent, really stellar example of a year that was just the beginning of one of the most serious bull markets we've had in modern history. But it's often years after the presidential elections when things can kind of go south, even in midterm elections, like in 1984, 83, 84 was a weak year after a huge run up when Reagan finally broke out of a 16-year holding pattern. Gee, I hope we're not doing that again. From 1966 to 1982, 16 years, the market was down. So if that's not going to happen, the presidential election year in 2024 should encourage an up market.
So expect to see an up market, right? Because all of a sudden, and I always said too, with interest rates being at a high, they typically tend to settle down. We were looking at charts, and obviously, this is just us doing our own research. But every year that interest rates had any increase during the first 3 years of a term, when the election year came up, they would just start to subside a little bit, here and there. And now here we are after all of these increases. This is the first time that we haven't had an increase. Do you think those are connected in any way?
Well, yeah, I mean, let me just riff a little bit more though on the presidential candidates and such. It does the stock market will often try to nudge the presidential candidates. If you remember the 2008 election, I mean, the market peaked in August of 2007 as the jockeying for position about who was going to be what nominee really was taking shape, and then at every instance tried to nudge things, and then really crashed, of course, at the end of it all, just saying that this was an unsatisfactory outcome, and stayed at that low level for 4 years. So we may see something somewhat similar in 2024, and I don't know how much this specific interest rate environment really matters. In that, let's say Congress extended the Trump tax cuts or had a comprehensive tax reform package in 2025, and that was nudged into existence by the market trying to lead the election in 2024. Well, that's one outcome. Another outcome is if the market is unsuccessful in nudging an outcome, and there are geopolitical tensions even bigger than we have now. Warfare can be very bad for the market. There's sometimes assumptions that war is kind of good for the economy. I mean, when Vietnam really got going in 1965, the market peaked for the long term in January 1966. I mean, there was no money to be made for over a decade. So we have to still wait to see what the market's going to nudge in 2024 before we're going to say it's positive.
That's good. And do you think, obviously, a lot of the Trump tax cuts expired, so we're coming into 2024. My take on it is obviously nothing new is going to be coming down the pike until we get through the election to see if anything changes. But you've done a ton of work on taxes. Do you see how some of these deductions positively or negatively affect the economy? And now that we're coming with some of them expiring, can you maybe just share, like, how does that work from an economy standpoint? Because some people think that they don't work and it doesn't help, and some people think that it does.
Yeah, I mean, the current rate structure is still pretty high. I mean, the top rate's 37%. I mean, you throw on a California tax rate of 13%, you're talking about 50%. So if those rates go up again, even a couple of points, that's going to change the return rate from 50 to 47 cents on the dollar in California. That's a 6% loss on a business return rate. That could be your entire margin. Yeah, I mean, the deductions, like most importantly for expensing and plant and equipment, right now, we've had a pretty nasty bout of inflation. That part of the tax code isn't very well indexed for inflation. So if those things go away, you could see a real reduction in capital expenditures. You can say goodbye to job growth if there's a reduction in capital expenditures. So yeah, the keeping tax law consistent over the long term, especially when there's a tax reform, is very important for long-term growth and market gains.
Mm. And do you see, if you could wave a magic wand and you could influence everyone that's watching, anyone that's in Congress, all the senators, anybody that is like, okay, what should we do, right? If we really cared about jobs, if we cared about the business sector, if we cared about markets, and we didn't care about any political interests, what would
Yeah.
be the magic wand or the solution to really solve all of the BS that goes on with taxes?
Yeah, I mean, there is a magic formula. That's the slogan of a friend of mine, Nathan Lewis, who writes about these topics, has come up with. And the magic formula is good money and low taxes. So if you have low, simple tax rates, so a system that's not characterized by high rates with lots of exemptions, but low rates with very few exemptions, there's very little to do in business aside from just go to work because you don't have to fool around with kind of gaming the tax. Hey, I better get that deduction because if I don't, I'll pay 40% as opposed to. So if you just have a low, simple tax code, lower the rates, broaden the base. We did this in 1986. As recently as 1980, the top income tax rate in the United States was 70%. That's 100 minus 30, 70%. 1986, they got rid of all these deductions, lowered that top rate to 28%. Nobody missed it at all. It's just like we don't need any of those deductions if the rate is low enough. So if you really take that rate down low, we did that with the corporate tax cut. We took it from 35 to 21, and corporations stopped worrying about deductions, at least to the degree they had before. Lower the rate, eliminate the deductions, let the market set interest rate policies, and we'll have a bull market that'll make the 1990s proud.
Ugh, I would love if we could wake up to that system.
Mm.
That would be phenomenal. What do you think? So, let's just say there's a politician listening, because I do think that there are people that get into office wanting to do good. They want to do good for their whether it's their jurisdiction or the people that vote for them, their electors, and they really want to do a great job. But they get in, and the machine is so corrupt, or is so large that you have to make all of these trades. But let's say somebody gets in and they really want to just do good, but they don't understand this enough to really know how to inform policies. Is there anything that you could share that maybe, like, this is what somebody could really focus on or vote on or start to draft policy on to really make a difference?
Yeah, Candy, I think you have identified it. When politicians come in their idealistic, they realize that there are all these traditions and interests that make things difficult. And here's where I'm a little bit worried about the narrow self-interest of an office holder. When an office holder comes in and sees a high rate of tax with lots of deductions, that benefits the office holder. Because when there are a lot of deductions, there are a lot of people coming to Washington saying, hey, can you give me a deduction? Can I get something written in the code for me? Because if it's a 40, 50, 60% tax rate, you need a deduction. And all of a sudden, members of Congress become very interested to moneyed classes in the United States. And that's where all the complexity in the tax code comes from. It comes from lobbyists when tax rates are high. So for Congress to reform the tax code to take tax rates way down takes an act of humility by Congress, because it means nobody's going to come around here anymore asking for deductions, given that the rate's only 15%. Don't care if I have a deduction or not. So that would dry up the business in Washington. In 1986, they called it Gucci Gulch. All the lobbyists wore their nice Gucci threads trying to impress the congressman. And they all were out of a job when the rate went down to 28% because, like, nobody wanted deductions anymore. The rate was so low. So the thing I would say to a new office holder is beware that office holders gain when there are deductions and exemptions from the tax code because they have to provide that favor. And office holders lose when the rate goes down. It's just that the country and business wins. So there's a certain kind of altruism necessary to the best office holder.
I love that. Oh my gosh. And I think that with that is power, right? So not only do they lose all those lobbyists coming to them, the ego pump of them needing them, but it's also they lose the power because now they don't have the special interests padding their pockets in their
Mhm.
next election, their next budget to run on the election. And I think that when we look at it, there's always and it's so interesting how it seems like politicians, instead of acknowledging what's real, is they try to create this class warfare around taxes, that the rich
Mhm.
are the ones that benefit and that the trickle down economics plans don't work. But really, what they're trying to do is just protect themselves and their pockets because they continue to get the power from the people, to your point, that are in the Gucci suits trying to impress them.
Yeah, the Laffer curve, the top rated Laffer curve, and Art Laffer and Gene Sinkman and I talked a lot about this in our book, Taxes Have Consequences. Laffer curve relating tax rates and tax receipts. At the top, we know that if you lower the top rate, say it's 37, really it's 40 with a mandatory Medicare add-on. If you lower it, you will get more money from the people who are subject to that rate. What's it, 500,000 or whatever it is, $565,000. If you lower that rate from 40 to 30, you get more money.
How is that? How
There's
is
no
that
question about
possible?
that.
To someone listening, how is that possible?
Oh, well, Warren Buffett in 2010, we analyzed this in the book. Warren Buffett in 2010 reported $40 million of income on his tax return, and his net worth increased by 10 billion. So his real income was 10 billion, but the tax code was written as such that he only legally, totally legally, no funny business at all. He only had to report 40 million out of 10 billion. Well, yeah, that's the ample opportunity the tax code gives to the super wealthy to avoid paying taxes. And in fact, if the tax code didn't have that, our economy would be completely broken. I mean, if rich people actually had to give 40% of their income every year, they would just give up. So there's no way we'd have an economy unless there were all these loopholes. So the solution to that is just to lower the rate down to 20 or 15 or something like that. 13, that's what Arthur Laffer says. And you just see all these loopholes dry up and would just be off to the races in terms of business activity.
Do you ever think it'll happen? Do you think that it's because it would have to be
Yeah.
presidential, correct? In order to,
Everyone, it would have to be Congress and the president.
yeah.
Mhm. Well, we almost had it in the 20s, just right out of the gate, baby income tax back then when Andrew Mellon was Treasury Secretary. He lowered it down to 24. And he was on a mission to get it down to 10 before forces aligned against the fate of this country. We almost got it in 86 when we took the top rate from 70 down to 28. And that rate stayed only for 3 years. It was raised as early as 1991 up to 31 and then 39.6. And I think Congress, I'm sad to say this, I think Congress realized that the business in Washington was drying up a little bit, a little not to their taste. And they knew that raising the rate, well, you're going to get more business in Washington. We got to, public service, you got to get that out of your head. And everyone's going to love you if we have a booming economy.
Oh, absolutely, right? I mean, that's the thing. It's like, can they are they willing to just take a little bit of a haircut now of their ego, and then everyone's going to love them
Yeah.
when everybody is making more. But I
Yeah.
think it's just that, like you said, it's that little bit in the beginning of them not having that continuous ego pump of significance of people
Mhm.
needing them in the business of Washington drying up to then become great. It's like the good to the great, right? To really give that up. Um,
Yeah.
yeah. So, and I love to, obviously, you talk a lot about the tax policies and like this, the curve of what rates need to be in order to really have a booming economy. Is there anything that maybe you can share for entrepreneurs specifically? Obviously, they're trying to leverage the tax law just as much as everybody else because they're trying to invest as much as they can back into their business and hire more people. So they don't want to be giving all of that money out. Is there anything that you can maybe share that you've learned? Or that you've seen just with entrepreneurs in general, that here's a few things that maybe entrepreneurs miss when it comes to leveraging the tax code in their favor, regardless of what year it may be.
Sure. One thing, I mean, Art Laffer and I talk about this in the book, and quite frequently together. There's all sorts of decisions one makes in gaining income in a business, personal, you name it. You can change the location of your income. You can get it in that state or this state or wherever. Tennessee, where I live, has zero income tax. Arizona is getting closer and closer to a zero income tax. California is a 13.3% income tax, progressive rates. You can change the timing of your income. You can change the manner of your income. And you can explore all sorts of other alternatives in the tax code about what form your income takes. And it is true that if you're a business owner who is unwilling to or uninterested to investigate that topic, you necessarily will be at a disadvantage to your competitors because your competitors have to do that. And if they're going to make sure they're in a zero income tax state and you're not, you're in New Jersey with 11% corporate rates. I mean, that's just right out of your margins. So, unfortunately, when you have a tax rate system that's very high, you have to get interested in the tax system. At the same time, you have to make sure it doesn't overwhelm your business form. That's Peter Drucker used to always talk about that. The form is supposed to follow function. You can't have the CFO design your company. So the United States, unfortunately, kind of makes you do this little dance where you have to be extremely worried about the tax code, but make sure that your function shines through necessarily.
I love that. So let's unpack each of those. So, location. Somebody listening to this, they're in California. They understand that. I mean, I've had a lot of friends and acquaintances and colleagues move out to Arizona during COVID because of realizing the whole everything with the tax structure. And I know there's always different schools of thought. So let's just get the reality. If somebody lives in California, but they're like, you know what, I want to
Mhm.
operate my business in another state. Can I pay less
Mhm.
taxes because I have my business in Florida, even though I live in California?
Yeah, and Candy, I mean, this is going to get beyond my competence in that I know that California has a very long arm in terms of making sure people don't book income in other jurisdictions when they are, in fact, in California. In most of the high tax states, including New Jersey and Illinois, have similar situations. Oftentimes, you have to make a full break, and it's exceedingly complex. And even the best of them, Arthur Laffer talks about when he moved from California to Tennessee in 2006, he didn't realize certain things. And like his tax lawyer said, yeah, you just either dodged a bullet or didn't dodge a bullet. So it can get very complex. But even within smaller jurisdictions, um, property tax jurisdictions, and California is very low property tax, which is great. But property tax jurisdictions can vary, by the municipality. You can have a 4% jurisdiction in one place and a 1% jurisdiction or sub 1% in another. And in that case, too, you also have to think about who you're employing, labor. If your labor has to pay a property tax as 4%, well, you're paying that because the labor price doesn't clear until your laborer pays all of his or her taxes. So we've found that a lot of business formation happens in low property tax places, a lot of because of labor. And, and the other thing is that it's very dangerous for businesses to play the game of trying to get a special abatement from taxation. There are lots of places like in Ohio where you simply have to do that to start a business or have a business. But invariably, that means that that place will be a much higher tax jurisdiction in general and will be innovating to the business process. So we recommend trying to find the lowest tax jurisdiction you can that's still viable for your product and then go for it.
I love that. Yeah, because I think otherwise, then it's again more energy and more focus of trying to find ways to get around it, as opposed to just where can you produce your product, where can you actually operate your company that's in a lower tax state. So I love that. It's way more straightforward.
I mean, I might give the mega example of Intel in Columbus, Ohio. Intel, the huge incentive, tax incentive against their 4% property taxes and all that stuff. And they set up there now that they can't hire 20,000 workers because nobody wants to live in a place with 4% property taxes. So, you can't, you have to have the whole thing. And that's, I think, why you see the zero income tax and low tax states really booming right now, almost carrying the entire capital burden of the United States. See, where I live, Nashville, Tennessee, you see it in Scottsdale, you see it in Florida, you see it in Texas, you see it in Washington State up to now, certainly Nevada, where it just seems like these states are the atlas that are just carrying all the investment in the United States until the rest of the country gets the picture.
Yeah, it's so true. I know I have so many, and thankfully now Arizona, like you said, we're starting to come back down. It went up, and now I think it's
Hmm.
4.5 to 2.5, and so they're going in the
Yeah,
right direction. And we went into
yeah.
COVID with a surplus. Like our budget, we had a surplus in the budget.
Mhm.
We came out of COVID with a surplus. So I think it's great when they start to make those great decisions. But you said something. You said the location and the timing of the money. Can you speak a little bit about
Mhm.
how people can time the money in their business?
Sure. Yeah. I mean, so let's talk about the businessman extraordinaire again, Warren Buffett, how he times his taking his income. So in 2010, he declared he made, he paid a less tax, smaller tax rate than his secretary. He said he declared $40 million in income, and he in fact made 10 billion because we know that Berkshire Hathaway increased his holdings from what 40 to 50 billion, I think. So he made 10 billion, but he didn't realize that income. So he didn't sell those shares of Berkshire Hathaway. So he might be waiting for a time when the capital gains rate is much lower. So, I mean, if we have a capital gains rate cut or if it's taken to zero, like Larry Kudlow says, maybe that's when he might sell his Berkshire Hathaway shares, or maybe he will let it pass into an estate when the basis is stepped up and then there's no taxation on capital gains, or maybe he will give it to a charity that eliminates its basis entirely. So that's a way that people are able to time their income. They have a form of income in which they don't have to realize it unless there's a favorable tax circumstance. And capital gains is a great example. Elon Musk, hadn't sold those Tesla shares for ages, and then finally he did start selling, probably to take some political heat off, and he ended up paying, who knows, a couple $1 billion in taxes. Bill Gates has said that he's paid more taxes than anyone else in American history. I'm sure he's correct. And he says he's paid $12 billion in taxes. Well, Bill Gates has made 200 billion. So that means that his effective tax rate is about 6%. And the statutory rate is 40%. Capital gains rate is what, 28.4%. So he's timed his income to make sure that he has paid a small amount of taxes, only 5%, say, on his big fortune.
And is there a way to, for a smaller business owner, let's say maybe under 50
Yeah.
million, that they're able to
Hmm.
even structure their business differently so that when they go to have a capital exit or they get an equity partner and they're able to get an influx of capital, that they can structure the money differently or the actual structure of their business differently to have that income tax differently?
Yeah. Well, yeah. I mean that has really changed, given the Trump tax cut corporate rate down from 35 to 21. So a smaller business is getting started. I mean, the goal usually is to be able to build up equity such that the profits of the company are and the potential of the company is represented in the capital appreciation of the stock that the owners own. And that remains untaxed as long as it's unrealized. So if you have a great business idea and you're starting to make some money, and a lot of people think, that's going to be a great business. You may go public, you may not. You may, want to take a private equity or may not, or down on the horizon. But the owner owns the stock that appreciates, at least notionally, without taxation. So if you don't sell it, that it's not a taxable event. So you are gaining real income in the sense that you're gaining net worth because your business is growing in value, but you don't have to pay tax on that. Now, when it comes to distributions, I mean, that is just virtually in every case. I mean, the corporate rate of 21% is pretty advantageous right now, I have to say. I mean, he used to be 52%. I mean, when the corporate rate was 52%, recently as the 60s, it was 48%, heck, in 1978. I mean, that business really had to load up on all sorts of things. I mean, all sorts of non-cash compensation for everyone, including the CEO. Pay his country club dues and his kids' school tuition and all that stuff instead of salary, because you could take the full payment as a deduction against taxes, but no one had to pay taxes on the payments, even though it was income. Fortunately, we're not in that world anymore, but that was the world back then. I mean, if this were the 1970s and you're a small business owner starting to make some money, you had to make sure your company paid everyone's tuition and country clubs and all that stuff, and that the vacations were working because you could deduct it against the 46%, 48% corporate tax rate, and then not run it through the 70% income tax side on the personal side. We're past that, but we still have a tax system we have to deal with.
Wow, that's it's crazy to think about. It seems like the wild wild west back if you had to offset
Mhm.
everything like that. Like that's again, business is already so complex. It's just the fundamentals of gaining customers and increasing profitability and staying afloat. I mean, we know from all the research we do on entrepreneurs, 91% of all businesses won't even hit their 10th year before they close. So it's like to have that
Mhm.
complexity that now you need to understand how to do non-cash compensation and pay that it's just so it's
Mhm.
so difficult. You would think that it would be easier for our whole society and our economy as a whole, that if you make things simple for people to understand, they can just go all in on the thing that we want businesses to do, which is to grow and to be able to make more money, to hire more people, and to just grow the economy. Is that is that idea that ideation just so simplistic that it'll never happen? Or do you think that there's a chance that sometime in our lifetimes that we'll see these rates come down to where they need to be in order for businesses to really be efficient?
Well, Kenny, let me stress, we do though live in somewhat of a golden era, the golden era that you're describing. There actually are entrepreneurs. There actually are lots of people who try to make a business succeed, a new business succeed for 10 years. That's phenomenal. That really did not exist in this country in the 1950s and 1960s and the 1970s. It really, I mean, that was the era of the big company. That was the era of the research lab engineer. And so many of those people were just wanted to bust out, but they could never amass a nest egg because their income was taxed up to 70% and they had to take their compensation in kind. And if you take your compensation in kind, you don't build up a nest egg and you can't bust out. And so, no, we live since the 1980s when we brought those rates down. We live in the entrepreneurial generation. So it's good that we're taking advantage of that. I would, yeah, totally continue to encourage your listeners. Yeah, right now it's way better than it used to be. Our marginal tax rate is half is what it was in the 1970s. At 37 used to be 70, used to be 91. You can actually start to amass some capital yourself, and you can hire people with the prospect of giving them something they want instead of something in kind. But that's why we had just a few employers back in the 60s and 70s. Those big employers employed 100,000 people and all that. General Electric, which is a great company, Westinghouse, all those things, just because no one could start a business in those high tax rates. When Reagan cut those down, that touched off the entrepreneurial wave, and we're still fortunately living in that world right now.
That's such great perspective to remember because I think so many of us weren't, building businesses or were even working back then, or I wasn't even alive back then. If you think about, so to not have that context and that perspective, it really makes you appreciate what we have now. And can it be better? Of course, but at least it gives you the opportunity to take skin in the game and to really try and to start your own
Mhm.
business. So I love that you shared that. Is there something that too, as we're going into 2024, like you said, most times in the election cycles, there's going to be somewhat of a rally for the markets. Do you predict, obviously, if you had a magic wand, that you think that's going to happen again, fall in line into this new year?
I think this time, I think this time the markets will take a stern look at the Democratic Party, and the market did very well in 2016. So when Trump was becoming a fait accompli in 15, 16, the market did very well. And there's, I think, reason to believe that the bull market of 2012 to 2021 was, one of the great bull markets, not as good as the 80s and not as good as the 90s, but heck, the index has tripled, and you never sneeze at the tripling of like the Dow Jones Industrial Average. And I think that was all kind of consolidating. Okay, Obama's in his second term, and he kind of isn't really going for socialism, and he's going to produce a reaction that is more on the supply side, Reagan-esque direction, and that's exactly what happened. So I think that bull market tracked the rise of a tax-cutting Donald Trump presidency, and then we had some concern about that when we experimented with the correction in the bear market in 2022. It's like, oh, that's all over. And now I think 2023, well, maybe it's coming back. So I think the market wants a tax cutting supply side presidency. I think that's what gave us the bull market of 2012 to 2021. Certainly gave us the bull market of 1982 to 1990. So I think if the Trump candidacy remains strong, the market's going to be strong. But if there are problems in that direction, if there are things like a Democratic supermajority in the houses, I don't know if the market's going to like that so much in 2024.
It's interesting. Do you think that everything that we've seen, from 2021 till now, obviously the real estate market has really drastically changed. We have inflation,
Mhm.
we have higher interest rates than we've ever had, at least in this cycle. Um, is there something that you can speak to, or maybe even help us understand? How did all of that happen at once? How did from 2021 to 2023 we had such drastic change in inflation and interest rates? And is that related to the presidency? Is that related to taxes? What kind of shifted everything?
My perspective, Candy, on inflation is that, and supply siders, from the supply side Reagan tradition, were very interested in inflation because there was just a horrendous inflation that brought Ronald Reagan into office in the 1970s. I mean, inflation was double digit routinely, 10% per year. I mean, prices went up, tripled in a dozen years, in the late 60s, early 80s, and that's crazy, especially when the tax code's unindexed for inflation. So no, I mean, I think inflation comes first of all from the credibility of the dollar. So, I mean, when the United States just started kind of producing budget deficits like crazy, well, how are you going to pay for those? You're just going to kind of create money for out of nowhere. Is the Treasury just going to create it and pay? That led to global, and I think it's not domestic, it's global dissatisfaction of the dollar as an exchange medium. And then when people speculate against the dollar, they speculate against into everything that is not the dollar, particularly something that can hold its value for the long term. So it has to be somewhat durable, like land. I mean, just it's not some ephemeral consumer good or service. So land, gold, those sorts of things will really go up when there's an inflationary cycle. And that's exactly what we saw. We see gold hitting new highs with land. So I think if there are tax cuts at the margin, corporate rate, personal rates, your depreciation remains very good as under Trump. I think you're going to see a lot of money flow into investments. And when flows into investment, there's demand for the dollar, and demand for the dollar brings inflation down. It also brings, kind of there's demand for money. That means it's going to raise interest rates because, like, we want that, we'll pay more for that money. And that's when you have to have a Federal Reserve System that's very responsive to producing money. And a much better solution would be kind of more privatization of money, kind of more experimentation into dollar alternatives, including cryptos, Bitcoin above all. So when you have a kind of a supple supply of money system coupled with a really intensive demand system because you got tax cuts at the margin, then you have the 1980s and 1990s all over again.
Mm. So
And that's great stuff.
yeah, right. Yeah. So the interest rates now, because I know there's a lot of people they're trying to get debt to buy assets, whether that's apartment buildings or, just real estate in general. They're now seeing that these are high. And now that's cutting into their margins of what they need for rent, returns, and all of that in order to
Yeah.
make money off of every single
Mhm.
asset. So now we have this perpetual system where it's like you can't pay as much for the property because now the interest rate's more. So they're trying to get the property cheaper. Is there anything that you see if the dollar stabilizes now? Because I do feel like, and I would love to know if you disagree. I was a little concerned with everything that was going on with the dollar to see that if we were going to be losing our position in the world, and I personally feel like that's not quite clear yet to know how well that's going to go. But if you can speak to that, and then even so, like, how does the interest rates work? Like, what caused it to go up every single quarter? All like, what was that? Is that the Federal Reserve that does that? Is that the administration that tweaks that? Is that just straight market and the inflation that causes that to happen? How does that work?
Sure. Yeah. Okay. Let me take each of those questions in turn. The first thing is just about prices of land. I really think, and this goes back to the 70s, that the prices of land are highly correlated to global opinion about the dollar. If the dollar has really good prospects, then people are going to be interested in investing in businesses, in financial assets. And they will move out of hard assets, including land and houses, in favor of financial assets. So, there was kind of nice stability in the Case-Shiller index in the 80s and 90s. Yeah, it was increasing in a secular fashion, but it really didn't go crazy until the 2000s when there was a bad business environment. So, when there's global satisfaction with the dollar, land does not go crazy. On interest rates, there are kind of two things that can push up interest rates. Number one, inflation. I mean, a lending institution cannot lend money at a rate that's lower than the inflation rate. It's a recipe for losing real money. I mean, so they can't pay their depositors legitimate interest rates if they're lending out money below the inflation rate. So if you have an inflation rate, you're going to have high interest rates. You can have high interest rates with low inflation rates. We had that in the 80s. And that happens when there's skepticism in the market about whether or not this inflation's gone for real. So we may see that so-called spread right now, where interest rates are kind of above the inflation rate. Um, so in terms of the global credibility of the dollar, I would say that the Federal Reserve and the administration are much less significant in terms of providing money and setting the interest rate in this country than is the global supply of the global market for the dollar. Global trade in the dollar every day is something like $8 trillion per year per day. So I didn't misspeak. It's the single largest traded market in the world, bigger than real estate, bigger than all stocks. Daily turnover in the New York Stock Exchange, something like $900 billion or something like that. Every single day, currency turnover, mainly in the dollars, like 75% of the dollar, is 8 trillion. So I don't think there's any way that the Federal Reserve or some petty institution can kind of like control an interest rate, because the money market is made by the global marketplace. And they send interest rates up, and now they're starting to relax because they think the business environment is going to be a little bit better.
That's fascinating. Now, when you spoke to it, and you said that there was a time where inflation wasn't that high and interest rates were still low.
Hmm.
What
Hmm.
made that different than what we've got right now?
Yeah. Yeah, that was in the mid 80s. So Reagan, Reagan came in the early 80s, President Ronald Reagan, and there was routinely 10, 11, 14% inflation. I mean, everyone had gotten used to it. Like, there's 10% inflation every year. So you had to get a 10% raise and all that stuff. And so interest rates began at 10%. They were usually 11, 12, 13, 14%. No kidding. And then he solved inflation immediately. He just cut taxes and inflation was gone. Gone. But the interest rate market was like, is this for real? Are they going to kick him out? Or is that, is Congress going to go along with this? Or is he going to have a change of heart? And so interest rates stayed high, up like 9, 10%, while inflation was down at 2, 3%. And you had this immense spread, which meant for holders of debt equity, like bond holders, just did fantastically. That's why you had the incredible bond boom of the mid 1980s. But after a while, everyone realized, oh no, everyone loves what Reagan did, and everyone's just going to fall in. And that's when you saw the spreads lower. Then the nominal interest rates went way down. So there's this long arc down to meet the inflation rate. And that was the kind of the extended drama of the 1980s and 1990s.
And that all shifted because of tax rates.
Yeah, I think so. Because when you cut tax rates at the margin, which is on the last dollar people earn, so that really incentivizes entrepreneurs and people doing business. Hey, if I make more money, I'll pay less taxes. Then that's when they want to go to the bank to say, hey, give me a loan. Now I want to make money because I get to keep it. So when the bank says, hey, there's all sorts of demand for money, well, then they start giving you money. They have facilities just to create it out of thin air with their fractional reserves. And you see the money supply expand naturally. It has a suppleness, and people pull out of gold. Gold went from 800 to $350 an ounce in the 1980s, and people pull out of land. That's that's a famous savings and loan land, fiascos. They invested in land in the 80s. People pull out of all of those inert hedges, and banks lend more. They create more money. The money supply expands, and that leads to the effect of kind of interest rates reaching their natural level. That tends to lower them in a context of energetic, positive economic activity. And that's all when you get to keep more at the margin. So that's why tax cuts at the margin have proven so significant.
And would it be safe to say that you believe that if right now, if we wanted to fix inflation and drive down interest
Mhm.
rates, that the way to do it is through the marginal tax rates?
Oh yeah, I would totally do it that way. Absolutely. There's no way inflation can abide a tax cut at the margin. You take that corporate rate down to 15%, that personal rate down to 20 or whatever. I mean, there's going to be such a demand for money. I mean, all the people who have business ideas are going to be beating down the holders of capital saying, "Gimme, gimme, gimme," because I got a great idea and now is when I want to do it. So when you have that kind of demand for money, nobody's paying an extra $7 at Starbucks. No, they're conserving their money because they have their great business idea. And that's when you see consumer prices not increase and hold the line, maybe even fall a little bit because people are economizing on money because they have great business ideas. No, I don't want to blow my money on consumer goods or wait out the economy in land or gold. I want to use it. Money's precious. I want to use it for a great business idea. And so when you lower marginal tax rates, you encourage that kind of attitude about money, and that's utterly anti-inflationary.
Oh, that's all. I wish, I hope we see that. I would love to see a
Mhm.
15%. I mean, that would be even key. I think, was it
Mhm.
2010? No. What did it, was it George W. that we had? Didn't we have at one
Yeah.
point a 15%?
Yeah.
Okay, it was George W.
Yes, we had a capital gains rate. We had a maximum capital gains rate of 15% for a couple of years under W. The problem with it, that was great, fine, but they were all temporary. And capital gain thing is a long term. I don't know. This is gonna take a long time to unfold, and the markets will realize. Look at Nvidia. He was working on that like a dog for 20 years, and then all of a sudden the stock price goes up 400 times. So yeah, sometime in there the capital gains rate was 15%, but you're not able to time your income on that all perfectly. So yeah, it was temporary in the W's case, welcome as it was.
Yeah. Okay. Gotcha. So I thought, I was like, wait, I think I remember this at some point. And then what has been since Reagan? What has been the lowest marginal rate? The top rate?
Yeah, the lowest marginal personal income rate is 28, and that was in 1987, 1988, 89, 90. And when he took office, it was 70, 70. It took it to 28, and then it's now at 37, but really 40 because Clinton made this mandatory Medicare add-on. So it's 40, has been as low as 28. And as Art Laffer and I say all the time, there's no way you're going to lose one penny in revenue. You're only going to gain revenue by cutting the top tax rate on the rich down from 40 to 25 or whatever.
25 or even 28, because that we at least have the data for, right?
Well,
It's not even
yeah,
like you have to
yeah,
make
yeah.
that
I mean,
number up. There's all the data.
no, there's all we have is glorious. In fact, we think you can take it well under 20, down to 13.
Wow. Well, if only you guys could run for office,
Yeah.
I think we would have a booming
Mhm.
economy. Um, one final question, because obviously, you guys look at all of this, everything in the economy. You understand how taxes work. If there was just one piece of advice that you would give entrepreneurs, investors, as we're coming into this season, based on all of your experience, just something that maybe you would share to say, look, if I was doing a business here, this is a few things that I would pay attention to, or what I would be doing. Is there something maybe that you could share with the audience?
Yeah, you're on the right time. This time, since tax rates are not over 50% and all that stuff, this is the time to be an entrepreneur. Excellent choice of timing, of generation. If this were the 1950s when the top marginal rate was 91%, you'd have to work for a big corporation. And a lot of those engineers in particular felt trapped. So you're in the right place. So if you want to start a business, you're in a great time for it. And the second is what Peter Drucker said is that the business organization has to follow the form has to follow the idea and the product. You can't let the tax structure dictate what your idea is. You have to be extremely attentive to the tax structure as you execute your idea. In fact, it will be fatal if you don't be extremely attentive. But the tax structure should not dictate your product or your idea. It should just be something you're attentive to.
I love that. Thank you so much I feel like I could talk to you for another hour. I want to be respectful of your time. Thank you
Yeah.
so much for just coming
Mhm.
on, for all the work that you guys are doing. I really hope that this gets out to as many people as we possibly can, because I think it's such an important conversation that taxes really do have consequences. So thank you for your time today, Brian. I appreciate it.